You're watching this because something just snapped in the silver market, and it didn't happen slowly, it happened fast. I'm talking about a 34% collapse in a single day, the largest one-day crash silver has ever recorded, while nearly $1 trillion in gold value vanished in under 24 hours. That just happened, and here's the part most headlines are missing. The real trigger isn't fear, or inflation data, or even interest rates. It's structural, it's mechanical. And once you see it, you won't unsee it. Stay with me, because I'm going to walk you through what's unfolding right now, and more importantly, how you can recognize this pattern the next time it shows up, before the crowd does. Before I explain what caused this, let me teach you something most people never learn about silver. You're not watching one market, you're watching two markets pretending to be one. On one side, you've got paper silver, futures contracts traded on places like COMEX, where prices are set by leverage, margin, and speed. On the other side, you've got physical silver, real bars, real delivery, trading in places like Asia, especially on the Shanghai Gold Exchange. Think of it like airline tickets. One screen shows discounted seats sold by algorithms. The other shows people actually lining up at the gate. Same destination. Very different reality. And right now, those two screens are telling completely different stories. Now here's why that matters to you. When these two markets diverge, when paper price says one thing and physical price says another, that's not just interesting. That's a signal. It tells you where the stress is. It tells you where the leverage is concentrated. And if you're holding silver, trading it, or even just watching from the sidelines, understanding this split is the difference between reacting to noise and actually seeing what's happening. So, if this is making sense, drop a comment below. Tell me if you're holding physical, if you're trading futures, or if you're just trying to understand what the hell is going on right now. Here's what you need to know. While US paper silver was collapsing, physical silver in Shanghai was trading around $120 to $130 an ounce. COMEX pricing, closer to 92. That's roughly a 40% premium at the same moment in time. Same metal, same day. Wildly different prices. And that divergence isn't theoretical, it's a signal. Because when paper claims outnumber real metal by something like 350 to 1, price becomes a function of leverage, not supply. So, when selling starts, it doesn't trickle, it cascades. Now here's what's actually happening. Silver had become a crowded momentum trade. January alone saw prices surge more than 60%, fast enough to pull in leveraged funds, short-term traders, and algorithms chasing volatility. Let me break down the sequence because this is important. First, futures prices run hot. Second, margin requirements rise and liquidity thins. Third, large players dump contracts, not metal, contracts. And when that happens, stops get hit. Forced selling kicks in, and price collapses in hours, not weeks. Here's what's wild about this. None of that requires physical silver to suddenly exist. It only requires paper holders to rush for the exit at the same time. But here's the part that should make you nervous. Physical demand didn't break. Premiums didn't collapse. They expanded. That tells you this wasn't demand destruction. This was stress showing up in the plumbing. When paper price falls while physical price refuses to follow, that's not resolution. That's tension. And I need you to understand the mechanics of why that happens. Because this is where most people get lost. When you've got a futures market where traders are holding positions on margin, they're borrowing money to control way more silver than they actually own. Let's say you put up $10,000. With leverage, you might control $100,000 worth of silver exposure. That's great when price is moving your direction. But when it turns, when silver drops even 5 or 10%, your broker comes calling. They demand more cash. That's a margin call. And if you can't meet it, they liquidate your position automatically. You don't get a choice. You don't get time to think. Your position gets sold at whatever the market price is in that moment. Now, multiply that across thousands of traders, all hitting their margin thresholds at roughly the same time, all getting liquidated simultaneously. That creates a feedback loop. Selling triggers more selling. Stops get hit, which triggers more stops. And because this is all happening in the paper market, in the futures contracts, the actual physical silver sitting in vaults doesn't move. It just sits there. But the price that gets broadcast across every screen, every headline, every chart, that's getting set by this liquidation cascade in the futures market, not by someone walking into a dealer and saying, "I don't want silver anymore." And here's the second layer. While that's happening on COMEX, physical buyers in Asia are watching those same screens. They see paper silver collapsing, and what do? They step in, they buy. Because they're not trading contracts. They're taking delivery, they're acquiring real metal. And when demand for physical stays strong while paper prices cratering, what happens to premiums? They explode. That 40% gap I mentioned earlier, that's not an accident. That's the market screaming that there's a disconnect between the derivative and the underlying asset. Now let me show you what very few people are talking about. The inventories. COMEX reported inventories have been dropping for months. Not dramatically, not catastrophically, but steadily. Meanwhile, registered silver, the stuff that's actually available for delivery, that's been sitting near multi-year lows. So you've got a situation where paper claims are stacking up, leverage is high, and the actual metal available to settle those claims is tight. That's not a problem until it is. And when a shock hits, when everyone tries to exit at once, that tightness turns into a choke point. This is the exact same playbook we've seen before. In 2011, silver surged. It became over-leveraged, and then it crashed violently. I'm talking about a drop from nearly $50 an ounce down to the low 30s in a matter of days, only to spend years rebuilding while physical demand stayed strong. In 2020, during the COVID shock, futures collapsed even as coin shops ran out of inventory and premiums exploded. Dealers couldn't keep 1-ounce rounds in stock. They were back-ordered for weeks. But the futures price? It had tanked. Every time this setup appears, crowded paper longs, tight physical supply, sudden leverage unwind, you get the same result. Sharp paper corrections that don't actually solve the underlying imbalance. And there's another one. March 2008. Right before the financial crisis really took hold, silver had rallied, got overextended, and then collapsed as credit markets seized up. But what happened after that initial shock? Physical buyers stepped in, premiums widened, and within months, once the dust settled, silver rebounded hard. Zoom out and you see the larger story. These events don't end cycles. They reset positioning. They shake out the weak hands, the leveraged speculators, and they redistribute metal from paper traders to physical holders. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this just be speculative excess unwinding? Absolutely. Markets can overshoot, and silver is notorious for volatility. And yes, not every divergence means manipulation or systemic failure. Could this be driven by macroeconomic factors we're not seeing yet? Maybe there's recession fears building. Maybe there's dollar strength that hasn't fully shown up in other assets yet. Could hedge funds just be taking profits after a 60% run? Of course. Here's the thing, though. It doesn't actually matter whether there's a villain behind the curtain or not. Arguing about motives misses the point. You don't need a conspiracy theory. You need to understand mechanics. Focus on what you can verify. Price spreads between paper and physical. Inventory levels. How leverage behaves under stress. Margin requirements. Delivery notices. Those are concrete. Those are measurable. And that's where your edge is. Not in predicting who did what or why, but in recognizing when the machine is under stress. There are probably 3 types of people watching this right now. Maybe you're already holding silver, and today rattled you. You saw your position drop 30%, and you're wondering if you made a mistake. If that's you, your job isn't to panic. It's to ask whether the reason you bought has actually changed. Did you buy silver because you thought it would go up every single day? Or did you buy it because you believe there's a longer-term case for precious metals, as a hedge, as a store of value, as insurance against currency debasement? If your thesis was long-term and nothing fundamental has changed, a paper market liquidation doesn't invalidate that. It tests your conviction. That's uncomfortable. But it's not the same as being wrong. Maybe you're a trader, you've been riding momentum, trading futures, maybe using options, and this move either stopped you out or it scared you. Here's what I'll tell you. This was a reminder that silver doesn't move politely. It doesn't respect technical levels when liquidation cascades hit. Position size matters more than being right. Risk management isn't just a phrase. It's the difference between surviving a day like this and getting wiped out. If you got hurt today, the lesson isn't don't trade silver. It's don't trade silver without understanding how fast it can move against you. And if you're just watching from the sidelines, feeling like you missed something or feeling relieved you weren't involved, Here's the truth. You're early to the lesson. These dislocations are how you learn to see risk before it headlines. You're watching in real time how leverage works, how paper markets can disconnect from physical, how sentiment can flip in hours. That education is worth more than whatever trade you think you missed. Different paths, same principle. Understand structure before you chase price. So here's what I want you to answer in the comments. Which category are you in? Are you holding and reassessing? Are you trading and recalibrating? Or are you studying and learning? Because your perspective shapes what you should do next. And I want to know where this community is right now. Here's where I stand. I'm not euphoric and I'm not bearish. I'm alert. First, I'm watching the spread between paper and physical prices. If that gap narrows quickly, it means confidence is returning to the paper market. If it stays wide or expands, it means the tension is still there. Second, I'm watching inventory and delivery stress. If we start seeing delivery failures, if registered silver keeps dropping, if premiums stay elevated for weeks, that tells me this wasn't just a trading event. It was a structural crack. Third, I'm watching how quickly confidence returns, or doesn't, to paper markets. Are traders coming back in? Are volumes normalizing? Or is everyone staying on the sidelines? Based on my analysis, this crash was mechanical, not emotional. It was driven by leverage, by margin calls, by positioning. The fundamental picture around silver hasn't changed overnight. Global mine supply is still constrained. Industrial demand, especially from solar and electric vehicles, is still growing. Central banks are still holding record amounts of gold and increasingly looking at silver. Monetary policy is still loose by historical standards. None of that disappeared because futures traders got liquidated. And if history rhymes, these kinds of breaks tend to mark stress points, not endings. They reset the board. They clear out the weak hands. And often, not always, but often, they set the stage for the next move higher once confidence stabilizes. I'm not saying silver's going to the moon tomorrow. I'm saying the conditions that drove it up 60% in January didn't vanish because of a liquidation event. They're still there. And the physical market is telling you that, loud and clear. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Seriously. Don't take my word for anything. Verify it yourself. Check the data. Look at the spreads. Watch the inventories. Form your own conclusions. But if you made it this far, you're the kind of person who wants to understand what's actually happening, not just react to headlines. That mentality will serve you well, not just in silver, in every market you touch. If you found value in this, share it. Send it to someone who's trying to make sense of what just happened. Subscribe if you want more breakdowns like this when the next shock hits, because there will be a next one. There always is. And the people who see it coming are the ones who studied the last one. Stay sharp out there. Question what you're shown, verify what you can, and make decisions that actually fit your risk, not the noise of the moment.